Hi, this is Chris. In this video, I'm going to discuss the difference between accrual method and cash method for your inventory. And I'm going to highlight this specific tweet that was sent out and I got tagged on it. And it says, so apparently after you make a bag off Q4, you can buy a crap ton of inventory towards the end of the year. Not too close because it might reflect on January statement and count that for the current year's business expense and tax deductible. Is that right? And yes, it is. If you are using cash methods. So the answer here is it depends. And I have a whole long drawn out response obviously on the tweet here, which I'm going to kind of just go over some of this here. And the basics of it is that there's two different methods of accounting. There's cash method and there's accrual method. And what a lot of non-ecom accountants will recommend you do is to immediately start out with cash. If this is your first year in business and your first year doing taxes, you have a choice to make. You can either go cash or you can go accrual method. If you've done taxes in prior years, you have to go with whatever your accountant had put you on previously. Trying to switch back and forth from cash to accrual is a very difficult process to do. So we don't typically recommend doing it unless there's a specific situation to do it. So generally, we're just going to follow whatever your previous accountant did. But if this is your first year, you do have a decision to make to either go cash or accrual. And what I like to always discuss when people ask this question is it's not just as simple as looking at it from a tax perspective. You have to look at it from a business perspective and a tax perspective. And the reason why you have to look at it from this way is it's not as cut and dry as can I save taxes this year or not? Because the easy answer is, which is what a lot of non-e-commerce accountants will give you, is if you want to save money on taxes this year, the answer always is use cash method. And the reason why is because the moment that you buy inventory, it's immediately expense on your taxes underneath the cash method. Underneath the accrual method, it means that when you buy inventory, it immediately goes to what's called an inventory asset. Then when you sell the items, it moves from inventory asset to cost of goods sold, which makes it tax deductible. So the only time you actually can write it off is for accrual method is when you sell it, which makes a big difference. Now, what tends to happen is when you have new sellers starting out, is their accountants will tell them use cash because it wipes out all of your money, all of your profit for that first year, which allows you to then buy more inventory. It makes perfect logical sense, and not to mention the accountant looks like a hero because you don't have to pay anything in taxes. But it sounds great. But you'll notice here I have a couple things you have to think through here if this is your first method. Because number one, actually, before I even go to number one, number two, there's two things that typically happens with sellers within a 3 year time span. Either A, you go out of business. I'm going to be frank about it. A large majority of companies go out of business within 2 to 3 years. A large majority of them do. Then the other option is that you're doing great and you're blowing things up. And depending on which scenario you're in, you don't necessarily want to get hit with taxes for cash method. And I'm going to explain to you the reason why. Number one, if you are going out of business in 3 years, which again does happen a lot, not that you're planning on it, but it happens. If you're using cash method your first year or two, you're likely pushing all of your expenses into those first 2 years, which effectively makes it where you're not paying any taxes for the first 2 years. But what that does is it shifts all of your income to that third year. And now when you're going to that third year, and let's say you start slowing down your inventory and you're potentially going out of business, what happens is all the income you've shoved out of the first 2 years is now applicable in year three because you don't have any write-offs for inventory. And that's the last thing you really want if you're going out of business. You probably don't want to deal with taxes. And the reason why you don't want to deal with taxes is there's a reason why you're going out of business. You're probably having to maybe go back to a 9 to 5. Maybe you just are going bankrupt. There could be various reasons why. But the last thing you want to deal with on top of all those problems is dealing with a tax problem. And that's the reason why I typically don't recommend starting out with cash is because you don't want to get screwed a couple years later. Now let's say you go the opposite direction and you're doing it really well. You're blowing things up. Well, typically when you're growing your business, you're going to want to start taking on debt in some fashion to be able to grow it even more. This is very typical. And the options you typically have are Amazon loans, Marcus loans directly through Amazon. Interest rates are generally higher than the market rate, but they're pretty easy to get, which is usually why people go there first. Then if you try going with all these other secondary sources of getting capital, they almost always have ridiculous high interest rates. Your best interest rates are always going to be with local banks and potentially backed by the SBA government. Now, to be able to do this, you have to have 2 years worth of tax returns. And those tax returns have to show that you're profitable. So if you're starting out using cash method, you almost always are going to show negative profitability your first couple of years in business. So if you try to go and get that loan on year 3, pretty much impossible. Not to mention, if you decide to leave your full-time gig and you decide to do this full-time and you need to try and buy a house or get any other sort of big loan for anything, you need to be able to show profitability off of your tax returns. Again, if you went cash method, it's not going to show up. You've got to be on accrual method. So that's kind of the reasons why I strongly recommend by doing that. Now, there's also other things to think about too, like if, for example, you have really, really, really high income right now from your W-2 job, and in a couple years you're going to leave your W-2 job and potentially make less with Amazon based on that, but you just want to have the freedom. Well, then maybe it does make sense to take all the write-offs this year because it's going to move your tax bracket. Like if you're really, really high income, like let's say you're $300,000 to $400,000 and you're paying 37% tax bracket for some of your income. If you can lower that, you're saving 37% in taxes by lowering it, by taking those deductions now versus later on. Those same deductions might be in a lower tax bracket because you're not making as much income. So that's a scenario that makes sense. But again, these are scenarios you typically should be talking with your accountant. And if your accountant immediately is just say, yeah, do cash, take the discount right now, you really have to think through what's going to happen over the next couple of years and see, does it make business sense to do that? That's really the way you have to look at it. And generally, most accountants will only look at the dollars and cents this year and tell you to take the deductions versus actually looking at it from a business perspective that's going to allow you to grow for multiple years or potentially put you out of danger a few years from now where you don't want to get stuck with a massive tax bill when you're going out of business. So that's kind of the thought process here as far as that. And then, looks like I had one here is another exception I put was maybe other ways of getting write-offs in the future to offset those gains may make sense as well, but very nuanced. And again, just talk to your accountant, and if they have no semblance of any of this, you're probably talking to the wrong guy. All right, if you have any questions regarding this, feel free to reach out. Thanks.